Hello, my name is Andrew Metrick, and I'm a professor of finance at the Yale School of Management and the director of the Yale Program on Financial Stability. We're now sitting here towards the end of March 2023. And earlier this month, Silicon Valley Bank, a bank with 200 billion plus in assets, failed and needed to be taken over by the FDIC in the United States. Today, I'm going to discuss the failure of Silicon Valley Bank. It's a very instructive case and tells everything you need to know about banking and bailouts. It can help us to understand financial crises of the past and really get a toehold even on understanding the big one, the global financial crisis of 2007 to 2009. To make sense of the module that I'm about to do, you really just need to know two things. First, what a balance sheet for a business is. A balance sheet has three main components: assets on one side, liabilities and shareholder equity on the other. If you have some rudimentary understanding of what a balance sheet is, you'll need that to understand what I do in the next hour or so. Second, you need a basic understanding of interest rates, what an interest rate is, and how the Federal Reserve plays a role in the setting of interest rates in the United States. With those two foundational things, I hope you will be able to not only follow what I do in the next hour, but also learn a lot about banking and bailouts from the very instructive failure of Silicon Valley Bank. As it happens, I've spent a lot of the last 15 years teaching and writing and thinking about the global financial crisis. I have an online course available through Coursera, which is free, that is co-taught with Tim Geithner, who was in government at the time of the crisis, about the global financial crisis. Turns out that it's really difficult to explain what went on during the global financial crisis. There's a lot of different steps. It's not just a bank failing, but rather different pieces of the financial system failing. And it's been a challenge, and I would say that over the last 15 years, our collective understanding, while it's moved a lot in the economics profession, maybe we haven't done a great job of explaining it to the world. Silicon Valley Bank, perhaps, is my opportunity to make amends for that. Silicon Valley Bank is a classic example of a bank run. It has the elements of banking crises that we've had since as long as we've had banking. Very straightforward. And what I hope to do today in just one module is explain what went on. In fact, I'm hoping to answer 4 questions. The first is, what actually happened? And was the thing that happened just some form of mass hysteria? That's big question number 1. The second question is, why did the government do what it did? Why did it take the steps that it took and not take other steps? Third, what we see after we answer 1 and 2 is the banking system seems a little weird, a little magical. Why do we organize it that way? Might there be a much simpler way to organize it? And then finally, what is it that we should do to best prevent these things from happening? And is it possible to completely prevent them? After you've watched this lecture, I hope that you are sufficiently inspired that you want to go and understand what was a massive financial crisis 15 years ago. And with the background and the straightforward way that Silicon Valley Bank failed and helps us to understand the banking system and bailouts of the banking system, you will be ready to really understand the grandmother of all crises, the global financial crisis. So that's our goal here, and got a set of, I hope, short units, each of which will take us through the steps necessary to answer these 4 big questions. Going through the entire thing will be the theme of the balance sheet of the bank. Because the balance sheet of the bank is actually where their factory floor is, where their entire business is really happening. People may be familiar with balance sheets for regular businesses. We have 2 sides to the balance sheet. On the left side is the asset side of the balance sheet, and on the right side is liabilities and equity. And the idea of looking at a balance sheet for any business is to get an understanding for here's everything they have and here's everything they owe, and that has been invested. And for banks, it's a particularly straightforward thing. What you see in front of you now is the balance sheet for Silicon Valley Bank on December 31st, 2022. This is an officially audited balance sheet. The accountants have been through it. And you can see that on the asset side of the balance sheet, they have $14 billion of cash. They have $120 billion of securities, things like bonds. They have $74 billion of loans. These are loans that they have made to other companies. So even though it's a loan for that company, it's an asset for Silicon Valley Bank because they will be paid back. And they have $4 billion of other assets. In total, at the end of 2022, they have $212 billion of assets. How do they pay for those $212 billion of assets? Well, that's the other side of the balance sheet. Their liabilities are in three pieces. By far, the largest piece of those liabilities are deposits. So if you are a depositor in a bank, you think of it as your money, but what you've really done is made a loan to the bank. So when you give money to the bank, it's your deposit. They promise to pay you some amount of interest, and you can take it out whenever you want. That's a loan that the depositor has made to the bank. So it is a liability of the bank. The vast majority of the funding that they have to buy the $212 billion of assets comes from deposits that people have put in their bank. We have 173 billion of those. They also have $5 billion of long-term debt. That is a bond where they will be paying it back over time. That is longer than 1 year. And then they have 19 billion of other debt, mostly short-term debt that they're paying back to various federal entities. The total amount of liabilities is 197 billion. The difference between how much they owe and the accounting value of what their assets are worth is 15 billion, and that's called their equity. Okay, so sometimes we think about, from the perspective of an investor investing in these things, that the equity is in the form of stock, and the liabilities are often have a lot of bonds in them. Here, most of the liabilities are deposits. Some of the equity is stock, but that stock is owned by a big holding company sitting on top. What you can see on this balance sheet in the upper right corner is two little things: net interest income and net interest margin. Net interest income is representing, here you see it's 5 billion. That's the total amount they are earning on their assets minus how much they have to pay on their liabilities. Net interest margin of 2.2% tells you what percentage that is of the overall base. Net interest margin of $5 billion, that's pretty much their whole business. They borrow deposits, long-term debt, other debt. They have investors who have given them some equity, and then they go out and buy assets. And they make their money just by having their assets earn more than they have to pay out in their liabilities. Much simpler even than a business that cuts your hair and charges you for the haircut and has to pay rent and labor and all these other things. Here, we can read it all from the balance sheet. But to understand what happened to Silicon Valley Bank, we have to drill a little bit deeper into exactly where that net interest margin comes from. So this is where we start with $212 billion of assets and $212 billion of liabilities plus equity. The story of what happened to them, which started around this time at the end of 2022 and lasted for the next 2 months and change until ultimately Silicon Valley Bank needed to be rescued in a form and resolved by the FDIC in the United States, was that depositors, this 173 billion that they had at the end of 2022, started asking for their money back. And you would wonder, well, why would that be? Because the assets in their balance sheet on this side, the accounting is $212 billion worth of assets. That's way more than 173 billion of deposits. There's plenty of money there. Depositors shouldn't be worried if they just count on the accounting value. But furthermore, even if we just do common sense values, cash is cash, that's $14 billion. The securities that they had, $120 billion worth of securities, are largely very, very safe things. A lot of them are liabilities of the US government, which is as safe as it can get from the perspective of putting it on your balance sheet. They have $74 billion in loans, but nobody was saying that they thought those loans weren't going to get paid back. That's a way that banks often get in trouble, is they make loans. If you can think about the mortgages that were written in leading up to the global financial crisis in 2008, they'll make loans. We think, oh, these aren't really good loans. They're not going to pay back. And that would be a reason to worry. Maybe that $74 billion isn't really worth $74 billion. But there was no significant questions at this time about these loans not paying back. Most people thought those securities, if they hold them for the entire time that the securities are out there, they'll end up paying back the $120 billion of face value they have. And same with the loans. So there was really not a question, either from a common sense perspective or an accounting perspective, of why the depositors would feel the need to run, to take their money out because they were nervous about the bank. Why would they be nervous? To understand what happened to Silicon Valley Bank in March of 2023, well, we need to go back a couple of years and understand how it grew since before COVID. That'll be helpful for setting the stage so that we can then look carefully at their business model and see how these different pieces fit together. What we have on the screen now is the 2022 balance sheet. And the key things, look at some of the big numbers on this sheet. They had $120 billion of securities. They had $74 billion of loans. They had $173 billion of deposits. These are the big numbers that are on there. Let's take a look at how that changed over the previous 3 years. This is just a picture of 4 useful items from the balance sheet: securities, loans, deposits, and equity. In blue is where those stood at the end of 2019. And in orange is where they stood at the end of 2022. You can see this is really massive growth. Deposits went from $62 billion to $173 billion. So they had $111 billion more dollars that they had to figure out what to do with there. Another $9 billion from equity. Most of the dollars that came in ended up going into securities. So $91 billion went into securities, whereas only $41 billion went into new loans to businesses. It's not really that surprising. Let's think of what was happening from the end of 2019 until the end of 2022, is that once COVID hit, there was a lot of stimulus in the economy coming both from government handing out money to people and to businesses where they thought they needed it, and from the Federal Reserve that was pushing interest rates lower. More on that coming. Basically, there was a lot of liquidity. And in particular, the area of the country that Silicon Valley Bank served was also seeing a boom in investment during some of this period. So many of their clients, predominantly their largest clients being tech firms and venture capitalists who invest in them, and the people who are the often wealthy people who work at those places, were a particularly highly liquid moment. And they took a lot of that money and put it in their bank. But it's hard to get $111 billion of deposits out the door into new loans all that fast. So for some of it, they just bought securities. And mostly they bought securities that were extremely safe. But that's a very important backdrop to recognize here. This is not a bank that was just moving along in a nice steady way. This was a bank that grew very fast. And indeed, for the people who watch over banks, for the regulators, for the supervisors, they often view very rapid growth of a bank as one thing to immediately go and look more carefully about. But it is important to note that there is no statement here that they went off and bought assets that people thought were bad assets. There's no sense in what they got here was something like subprime mortgages or loans that were extremely risky for enterprises that might fail quickly. No, most of what they did is in this column going from 29 to 120 billion, where they bought safe government securities. So how can we get in trouble doing that? Now let's move all the way back to 2019 and take a look at the balance sheet that's there in 2019. And what we see here is the numbers from the previous picture. They're much smaller than the numbers that we saw from 2022. The total amount of assets is 71 billion. The total amount of liabilities and equity is 71 billion. They always have to add up on both sides. And if you look in the top right corner, you see that the net interest income at this point was only 2 billion. So significantly lower. This seems like a much more profitable enterprise in 2022 when this was 5 billion than it does here at 2 billion. But of course, the asset base had gone up considerably between 2019 and 2022. So perhaps it's not that surprising that they're earning more net interest income. But where is that coming from? Said that the whole business of banking is to make more on your assets than you have to pay out on your liabilities and equity. And there's three components that go into that. So what we're going to do now is unpack those three components. And once you understand what those three components are, where they come from, it's easier to see how Silicon Valley Bank got in trouble. Okay, other than balance sheets, the one other very important picture for us to look at is yield curves. What we see on this chart is a basic yield curve for the United States government at the year end of 2019. On the y-axis is the rate that is being paid in percent, and on the x-axis is time. The time is not drawn to scale. In a standard way, we like to break up the early years going from 1 month to 3 years into much smaller pieces and then really spread it out all the way up to 30 years. This gives you a sense of what it costs the United States government to borrow at all of these different time horizons. The yield curve is fundamental for understanding what's going on in any financial business. And usually, the yield curve has an upward slope like the one that you see here. So this is the actual yield curve from the end of 2019. On the left side, you can see that for 1 month, if the government is borrowing for 30 days, which is something that it does often, it would have to pay about 1.5%. We also say 150 basis points. This is approximately 150 basis points. All the way at the other end, if the government is borrowing for 30 years, it was closer to 2.5%, or 2.4% to be more precise. So the difference between what it would cost the government to borrow short-term and what it would cost for them to borrow long-term here is almost a full percentage point. I'm going to put in a dotted line here just so we can see that difference. We would call that the term spread. So in general, if you just go back through all of history and you're always borrowing, for example, at a very short end and paying the interest rate of a 30-day interest rate, but lending at a long end and getting paid that, you're usually going to just earn returns from that by itself. Now, there's a big debate about why that is, and it's not always true, but it's important to note that it is usually true. And it is usually a reason that banks can make some money. Because if you think about a type of loan a bank would often do, think of a mortgage loan, which will go for 30 years. The average payment won't be 30 years long, but it's a 30-year transaction. And that will typically just have a higher rate than a similar type of loan that would be very, very short term. And so since they're usually getting most of their liabilities short term, and a lot of their assets take a while to mature, they're typically picking up a term spread. So one piece of this net interest margin is just the difference between that you get in general from borrowing short and lending long. A second piece, though, comes from the fact that some of the loans in 2019, at the time that we're drawing these pictures, half of their assets were coming from loans that they wrote, not securities, not government yield curve, but something a little riskier. Lending to the government is still, thankfully, considered to be essentially risk-free. But when you're lending to a business, it's not risk-free. When we think about the typical bank business, the typical things that they're doing, we're often thinking about them finding good investments, good businesses to loan money to. A restaurant would be an example, or in Silicon Valley, you might be lending to some sort of tech firm. Often you're going to have some collateral, maybe very good collateral, but you're still going to have some risk. And because of that risk, the red line here, the risky loan curve line, will typically look like a risk-free line in blue with some extra piece on it. Here's the piece. We'd call that the credit spread. In this example, I've just given an educated guess that this is 150 basis points, 1.5% higher than the risk-free line. The exact number doesn't matter for the discussion that we're going to have, but it is higher. Now, keep in mind, you only get that if the investment pays back. So this is not the same thing as saying they're expecting to get that whole credit spread. But if they're brilliant lenders, and they know exactly with perfect foresight who can pay back and not, and they're able to capture this difference, then they're always going to get paid back, and they'll always earn that credit spread. Banks often get in trouble when they make mistakes in that, and even though they're hoping to get the red line, they might end up getting zero. But if they're getting the red line, then they get this additional piece. The third thing that makes up the difference between what banks have to pay for their liabilities and what they get in their assets is the fact, as we saw, most of their liabilities are in the form of deposits. The yellow circle, that's the actual average amount that Silicon Valley Bank was paying on its deposits at the end of 2019. Half a percentage point, 50 basis points. In fact, 2/3 of the deposits at Silicon Valley Bank at the end of 2019 were paying zero. And you might ask, well, why? Would people be willing to accept zero? It's actually not that hard to understand. Let's keep going and then talk about why that might happen. So I've extended out the dotted line here in the deposits, extended it out from the circle. The circle is very, very close to the y-axis because generally with deposits, you can go take them out anytime you want. There's no term on them. I'm extending out the dotted line because what makes a bank really happy often to have deposits is that even though people can take them out anytime they want, they usually don't. They usually take out what they need for whatever their transactions are and leave a fair amount of money, in the case of Silicon Valley Bank, well north of $100 billion in their deposits, earning lower amounts, even though they don't necessarily need it every single day. The reason for that is that deposits have what we call a convenience yield. When you put a deposit in a bank, it's not the same thing as having a government bond. We like to think it's just as safe, but it can do things that a government bond can't do. You can, for example, pay for your lunch with it and pay your bills at the end of the month. Take, for example, a corporation. Imagine a corporation had $1 million sitting in Silicon Valley Bank, and they were using that for their regular payroll. So money would come in, money would come out. On average, there was $1 million that was sitting in there. And let's say that they were the average Silicon Valley Bank customer, and they were receiving 50 basis points on their deposits. That's a whole 1% less, and these are the real numbers, than the government had to pay at that time. What would the business be receiving for that 100 basis points? Well, they had their money, it was available, they could do their payroll out of that. They could do any of the regular expenses that they had out of that $1 million. What was it costing them to leave it in the bank instead of, say, running down the street and calling their broker, because they're a big company, they have $1 million sitting in their bank account, they could call their broker and they could buy a government T-bill that would pay them a whole percentage more. what was it costing them during that year to leave it in the bank and earn only 50 basis points? It was costing them that 1% on the $1 million. That's $10,000 a year. So let's ask, is the convenience of having a place that could easily do this worth $10,000 a year to a business that has that kind of flow and that kind of, doesn't seem like an unreasonable number. So it's a service the bank provides. It's one of the ways they get paid. When we look at this whole picture and we add up those ways they get paid, we see these three elements. They're paying out a deposit rate which is pretty low, but they're providing the service of convenience. They're receiving the term spread because a lot of the loans and also the securities they buy are longer term than the very short end of the curve. And if they're smart investors, they're also capturing the credit spread. If they do their job well, that whole thing will ultimately represent their net interest margin. With that starting point of seeing where it is that the bank is making money, now we can see what happened between 2019 and 2022. These are the actual lines. Well, the blue and the yellow are actual lines, and the red is a reasonable guess of where they were earning their money as of the end of 2019. What then happened? Well, we have COVID. Okay? And with COVID, which first hits us in March of 2020, over the course of 2020, the Federal Reserve kept pushing down their target for interest rates. So by the time we get to the end of 2020, December 31st, 2020, the green line shows us what the government yield curve is. So up to 1 year, it's basically just sitting right there at zero. You know, they're paying essentially nothing. Government is paying essentially nothing to borrow. Interest rates have been pushed down so low. And even if we go all the way out to 30 years, we're still only a little bit higher than what the government had to pay on 1 month things 3 years before. The yield curve is still upward sloping. Indeed, it's got a little more of a slope than it used to have. But it's significantly lower than it was in 2019 in just 1 year. Now, remember, it's during this year, a lot of money is starting to pour in. This year and the next year. A lot of money is starting to pour in to Silicon Valley Bank. And what are they doing with it? Okay, well, they're going to take a lot of this, and you might think, well, why don't they just put it in the safest thing that they can, which is also very short? That's a tough business now to be in. They're still paying something that's going to look a little bit higher than zero. The yellow dot would be moving around here too, but they're still paying something that looks a little higher than zero. If they put it in the very shortest government things, they're just going to earn no money at all. So they think, well, until we can get this into loans, let's at least go further out on the curve and get something. It's government securities that we're investing in. Those will be a little bit safe, or a lot safe. And so for a lot of what they did, they purchased either direct U.S. government liabilities or things related to guaranteed mortgages from the government. But again, things that nobody thought then and nobody thinks today are in danger of not paying back. A lot of the new money went into that. Now, by early 2022, it was clear to everybody that we had an inflation problem in the United States, not just in the United States, and that the main way that you can push back on those types of inflation problems is for the Federal Reserve to try to slow down the economy by pushing interest rates up. That's the standard medicine for what we do if we think that there is an inflation problem. That's the playbook, and while there's debates about whether the Fed should have started earlier or gone slower or faster, what's important to us for understanding Silicon Valley Bank, is what things look like by the end of 2022. Let's do that. That's in orange. Couple things to note about the difference between orange and green. And they're both very easy to read with the eye. The first is, it's a lot higher. Okay, so short rates, the shortest end of the curve, around 1 month, government T-bills, is already above 4%. And indeed, it's a little bit higher than the 30-year. So the second piece is that second thing that we can read by looking at it is if you look at the shape of the line, it's now basically flat. Or in fact, a little bit downward sloping from the beginning to the end, if you go all the way from the beginning to the end. That shape difference will also matter. So this change, if you think of what happened, a lot of money came in through deposits, and they were pretty much stuck with being somewhere on the green line for that. And then by the end of 2022, suddenly the world was on the orange line. Note that the orange line is considerably, is above everything, all the 2019 lines, including the risky ones. That means that the government, the US government, if it wanted to borrow for 30 days, had to pay a higher interest rate than probably Silicon Valley Bank could be expecting to earn on any of the assets that they had. Okay, so they have a whole bunch of assets out there. Some are loans, some are securities. But if they had bought them a while ago and put them in place a while ago, because it takes a while for long-term things to mature, they should generally be expecting to pay more if they were the government, for example. They were expecting to pay more on that than what they would be getting in those assets. That's one fundamental challenge. And it is not unique to Silicon Valley Bank. This happened all across the country. We're going to be talking about Silicon Valley Bank specifically because we have a lot of information about it and we know they failed. But this same dynamic is playing out to various, more or less degree at every bank in the United States. Okay, we've just looked at this picture about what happened to the yield curve. Now let's go back to our other favorite picture, the balance sheet. Okay, so here's our balance sheet. This is what we started with. This is where we stand on December 31st, 2022. Okay, and if we recall, we have the asset side with a total of $212 billion, and the liabilities of $197 billion, and $15 billion of equity or cushion that we have, such that if we sold all the assets and got $212 billion and paid back all the liabilities, we'd have $15 billion left over. But we've also discussed what has just happened in the yield curve world. And one thing that does, and this is a sort of a quite important, it's a little piece of math, but not a big piece of math, is what that does is your securities portfolio, if you're already holding a bond, and that bond is promising to pay you 1% per year, and suddenly interest rates go up so that now people can go and buy a bond that pays them 4% per year, your bond is relatively less valuable now. If someone can just go out and pay $100 and receive a bond that will give them $4 a year for a long time, and you're sitting holding a bond that you paid originally $100 for, but it only pays you $1 a year, no one's going to give you $100 for that bond. Right? They'd much rather spend their $100 on something paying 4%. And the math behind this is pretty straightforward, but the direction is really clear, which is if you own things, even things that are super safe, didn't say anything in that last paragraph about not being sure if you were going to get your $1 a year or your $4 a year. We're sure about it. It's just that, hey, when interest rates are higher, I'd rather put my money in some new thing with a higher interest rate than an old thing with a lower interest rate. That tends to drive the value of that down. So how would that be reflected in Silicon Valley's balance sheet? Now is where we start leaving the incredibly obvious, and this makes a lot of sense, world to a world of where it seems a little bit mysterious and magical. Okay? And in fact, that is banking. What we're going to do now in red is I am going to mark to market the value of the securities. That is, they have $120 billion worth of securities. So if we imagine, what is that? One way to think about that from an accounting perspective, or even a common sense perspective, is that if they held on to those things forever, they will eventually pay them back. They're going to get all their money back by the end of $120 billion. They're all face value. That's one way to think about it. But because we know that the interest that those things are paying is a little bit lower, or in some maybe a couple percentage points lower than what someone else could get on a different bond, if you actually tried to go to the market, take that $120 billion of face value of bonds and sell them, you would get $103 billion for this. Take that as just truth for now, and I'll explain where we get it from in a minute. But imagine that that's actually true, that the $120 billion that you would get if you just held on to it, because it's government promised to pay you $120 billion, but not for a while. If you held on to it, you'd get it. But if you tried to get it today, if you needed it today, you would get $103 billion for it. What does that mean now? What kind of other adjustments would we make to the balance sheet? First, recognize we're already doing something a little bit funny. Because when we wrote the balance sheet, we were following certain types of rules. Those are the rules that the accountants tell us you have to follow. And in those rules, we were just writing things down at the value that we thought they would ultimately give us. That's why we had the $120 billion. Now I'm doing something a bit different, which is say, well, I actually can see this thing has a market price. I can see what it would be if I sold it today. Maybe I shouldn't just write $120 billion down. Maybe I should write $103 billion down. And so if we do that, what does that do to the rest of the balance sheet? Well, you now have $17 billion less in assets. What does that mean? Well, where does that come out on the other side? It doesn't change the liabilities at all. So if I was actually going to mark to market where that happens on the balance sheet, it would change the equity. Both sides always need to add. So the equity goes from $15 billion to minus $2 billion. The totals on both sides still balance at $195 billion. Okay, so the important point here, really and using red helps us to see that, because red tells us we're in the red, is that now, if you were to just say, here's the mark-to-market value of these securities, then you would also say, well, seems to me if I just had to roll this whole thing up tomorrow, sell all the assets and pay back all the liabilities, I don't have enough money to pay back all the liabilities. So that's a starting point, and that's always a starting point for why banks end up getting into trouble. In this particular case, these numbers were known. It's not as though we had an army of smart people digging through the records to figure out what this is, or it only became clear after they failed. This was disclosed. At the end of 2022, this was disclosed, and it was in their filings, and everybody could see it. So that's sort of weird, too. If everybody could see this at the end of December 2022, and they were at least willing to keep their money in, why suddenly in March did they decide they need to take their money out? And again, this kind of pulls us back a little bit to the fiction of the way that banking works, which is while they had to disclose that actually their securities would be worth less if they sold them, the accounting, the formal accounting thing that they say when they say, here's how much equity we have, they're still allowed to say $15 billion. And it's not completely crazy. It's based on the following way of thinking about a bank, which is, hey, those deposits are sticky. They're not going to leave. And if the deposits don't leave, then we don't have to sell the securities. And we don't have to liquidate the loans. And if we don't have to liquidate the loans and we don't have to sell the securities, they're still going to ultimately give us 120 and for the securities and 74 for the loans, and we're still completely solvent. So this word solvent, you'll start to hear a lot. That basically is just, is my amount of equity positive? Are my assets worth more than my liabilities? Back when we were talking about this as a pure accounting world, just in orange, they were solvent. They are accounting solvent here, and indeed that is what they reported, even though also if you looked at you could see, they would say, oh, and by the way, if we mark these to market, they'll be down. So if we do a partial mark to market, then they wouldn't be solvent. But it's a partial one. So what's now going to make the deposit holders decide that they're scared? Now, this is not a mystery to any of the sophisticated investors in the world who are looking at this financial information, and indeed, people were writing about it, and it was out there. It's not a mystery to the supervisors who are looking over this bank. In fact, they've had insight into this much longer than the public has, since they've known what these securities are for a long time. So along the way, what is everyone doing? Everyone is, or I'd say the supervisors for sure, but certainly the sophisticated commentators and a lot of very sophisticated people who have their money in Silicon Valley Bank, basically saying to Silicon Valley Bank, it would probably be good if you had a little more of a cushion. Right? We recognize that if we mark only part of your balance sheet to market, then you might look insolvent. And from an accounting perspective, you're still solvent. Your assets are worth more than your liabilities. But overall, this is not really, doesn't make us feel super safe. And Silicon Valley Bank management understands this as well. So they're actually, during some of this time, trying a variety of different ways to raise some equity capital. So they're out there saying, let's get people to actually hand us over money. But it's not debt. It's not a deposit. We're not promising to pay it back. It's an investment. It's like stock. Okay? That would go in the equity part of the balance sheet. And they're out there looking for that. And people are kind of hanging around watching that. Then one day they end up disclosing that they've sold some of their securities. And when they sold those securities, it wasn't particularly new information. People already knew that those securities were a little bit underwater, but now they had to actually recognize some of these losses very specifically. Once you actually sell it, you have to admit to it and recognize it. That's kind of a funny thing. Well, we figure they're out there looking for some equity. That would be the easiest thing for them to do, get some equity, announce they have some equity, everyone thinks the bank is strong. Instead, they're selling some of these securities. They're selling them at a loss and kind of admitting it. That's the kind of thing that makes you a little bit nervous. I mean, again, just looking straight at these numbers here, on a mark-to-market basis, it's not clear they could pay everybody back. And now we see them selling some things. Which kind of signals maybe they haven't been able to get anyone to invest in them. That's something you might think. If you don't see all the details, you might have other reasons to believe that. So at this point, if you're a sophisticated investor or a non-sophisticated investor, you would say, what am I getting out of this relationship exactly? I mean, at this point in time, 173 billion in deposits. By the time we get to 2022, half of those deposits are still paying nothing, getting nothing. Now, interest rates are considerably higher. They're over 4%. You can go get a CD for over 4%, a certificate of deposit. So you're giving up a little bit more than you used to be giving up. Furthermore, something that makes Silicon Valley Bank somewhat unique, kind of far out on the curve of doing this, is that more than 90% of the deposits that Silicon Valley Bank had were in fact not insured by the FDIC. Now, people have written a lot about this. I won't belabor it. People watching this video who have managed to get this far probably have heard this part of the story. But when you put your money in a bank, the first 250,000 of it, if you're one individual, is insured, and you're going to get it back. The government's standing behind it. But everything above $250,000 is not insured. Okay, so in principle, you can lose it. Silicon Valley Bank had the vast majority of their deposits uninsured. Compared to other banks, they had significantly, they were way in the tail of the distribution. Now that's not all. The country as a whole, it's almost half of deposits that are uninsured. So it's not a small number. But at Silicon Valley Bank, it was higher than 90%. So here you are, you're an uninsured depositor. Maybe you're earning zero or something a little more than zero. And you're thinking, what am I getting out of this? There's some chance here that's certainly not a zero chance. There's some chance that they actually couldn't pay everybody back. Do I want to be the last person in line to get my money out if that happens? What's the upside of staying, too? They're not paying me very much, and this place down the street can do pretty much the same service for me. It's a pain in the neck. It's inconvenient. I had a long-term relationship with Silicon Valley Bank, but I don't want to lose all my money. So the first thing to note here is it is not at all irrational and was not at all irrational for people on Thursday, March 9th, in looking at what was going on to think, maybe it makes some sense that we take our money out. That was a completely reasonable thing to think. However, if everybody thinks that, and indeed 42 billion in deposits came out that day, if everybody thinks that, it starts to be a problem. Because if you look at the cash side of the balance sheet, there's only 14 there. They're going to need to go and get another 28 billion from somewhere to hand over to people in the form of cash. That's where things start getting tricky. If they go and they sell more securities to get that cash very fast, well, they're going to have to recognize even more losses, and frankly, securities, which are pretty easy to sell, if they sold all of them and everybody really wanted their money back, they couldn't do it. So in a world where they really had to immediately pay their deposits back and only got the mark-to-market value of their securities, they'd be in trouble. How about their loans? You can't sell those, not very fast. So the really only options that they had were to try to somehow find somebody who would let them borrow using these things as collateral. Leave aside now for a moment whether or not they're able to do that, and imagine we're back in a world where that wasn't possible, because for some technical reasons it's going to be really hard for them to do it here, as I will explain. It's easy to see how, if they can't borrow on it and they can't sell it, they're basically going to go out of business. And at the same time, their depositors were behaving in a reasonable way. Now, we talk a bit about Twitter and the way that people started to tell their friends and tell the people they work with, go take your money out of Silicon Valley Bank. 42 billion, that sounds like a lot of money to go out in one day. I think it's a red herring to blame technology for this. We've been having bank runs in the United States for as long as we've had a United States. And they've always been fast. In the old days, you used to be able to, they would be fast because banks were fairly local, and you would look out your window and you would see a big line of people outside of the bank. That was very viral. Okay? Very quickly, you see a big long line, it's outside the bank, you go and you stand in it. Bank runs happened really quickly in the 19th century, even before we had telephones, much less Twitter. And so while in this particular case, the fact that it happened in Silicon Valley and people were pretty sophisticated enabled it to happen in, let's say, 12 hours, whereas maybe in the 19th century it might have taken a couple of days, is not really the driving force. The driving force is, ultimately, there were good reasons to be concerned about the solvency of Silicon Valley Bank. So to answer the first question posed in this module, which is why did it happen, and was there some sort of crazy kind of mass hysteria that made it happen, I think that's really not consistent with the evidence, and it's not consistent with the way bank runs have happened in the past. All right, so we've talked about how we got there, how we got to March 9th, and then on March 10th, ultimately a decision was made by the FDIC in the United States, which is responsible for the insurance of the deposits that were insured deposits. But it's also their job, when they think a bank is no longer viable, to go in and take over that bank. Okay? And what the FDIC usually does when they take over a bank is they try to very quickly find a buyer for that bank. The typical way the FDIC will do this is they'll observe, they think a bank is in trouble, they think a bank is not viable, and they will typically try to go in on Friday after business hours, go into the bank, take it over, and get it all sold and organized before Monday morning. So then people show up Monday morning and they don't even know what happened, and all their money is there and all their money is safe. In this particular case, because things were happening pretty fast, and it's not the first time that's happened, and it's not only in the Twitter age that that happens, they had to go in the middle of the day on Friday, March 10th. They went in on Friday, March 10th, and over that next weekend made their first efforts to try to sell what was left there at Silicon Valley Bank to another buyer. And what the FDIC typically does in those cases is they're willing to take some losses in order to get this done. So they have promised to pay the insured deposits. Over that next weekend, they actually said they would pay out the uninsured deposits as well. We'll be discussing that soon. But once they've said those things, they're going to try to get as much as they can for all the rest of the stuff that's on the balance sheet and take that money and then combine it with the fund that they have in order to do that. So it took them a couple of weeks, but they eventually did sell most of the elements of this balance sheet to another bank. Another bank took over, that's First Citizens Bank, ended up buying. On the asset side of the portfolio, they bought all of the loans. So they said, all right, well, we're happy. We'll we'll put this into our own balance sheet. Give us all the loans. They also took all the remaining deposits, which was significantly less by this point. What's important, though, about this is that when they took the loans, they said, we're going to pay $16 billion less for the loans, $16.5 billion less for the loans than you actually had them on your books. So the numbers that we have here are a little bit different than what happened in the transaction, but the difference between the loans, how they were booked, and ultimately what they paid for them, that's the right numbers. It's $16.5 billion. So that's weird. I had said earlier, and I would still say, there's not much concern that these particular loans that they had made to businesses weren't going to pay back. That wasn't the problem. So it wasn't as though they looked at the loans and they said, well, I don't know, you think you're going to get $74 billion, but I think you're only going to collect $58 billion. That's not what happened. What happened was that when they actually sold the loans, the same calculation that we would have done for securities by saying, hey, the interest rate on this is much lower than what I could get today, so the value of it, if I tried to sell it, would be lower. That same calculation also applies to loans. We never do it because there's never a market, and the market isn't liquid enough to do this. It's not the type of thing that you're going to see typically on a bank balance sheet. In fact, the only time banks are really required from an accounting perspective to tell us about these things is if they think they won't collect on the loans. If they think they will collect on the loans, they don't have to do this kind of marking to market. So I put mark to market question mark here because we don't know exactly how this would have been handled from an accounting perspective. It's not the same exact animal as the mark to market on the securities portfolio, which is a very formalized way of doing it in the accounting statements. But we have a pretty good idea because this was a market price, right? First Citizens paid $16.5 billion less for the loan portfolio than it had been sitting on the balance sheet. So indeed, if we run this through the rest of the balance sheet and we say, well, not only was it the case that the securities were worth $17 billion less than we had them on there, but now we know, once they sold this, we can observe, here's what the market thinks about the loan portfolio, and we didn't have that right either. That's at $58 billion. Okay, so what's going on? Let's track this now all the way through. Where does that come out? Well, it always comes out of equity. So the loan portfolio, which has been marked down now, if we wanted to mark it to market by another on here, 16 billion, means that the equity, instead of being negative 2 billion, would actually be negative 18 billion. So if somebody was actually really just trying to think about what is this bank solvent or not, and they were being reasonable and rational about the loan portfolio, which is not something we usually do, but it's an exercise that a sophisticated investor could do, they would have a completely reasonable position if they said, I think that the equity level is negative 18 billion. That's really insolvent. So afterwards, we even learn a little bit more. And indeed, the FDIC has reported they expect to lose $20 billion on the overall resolution of Silicon Valley Bank. So what does that mean? The bank is going along, it's doing its thing. People ask for its money back. They just start giving its money back. At some point, the FDIC says, we're going to stop this process. Then they're going to go and effectively get rid of the whole thing. And they say, this is going to cost us $20 billion. That indicates that by some definition, this bank was not solvent. The story, though, that we will often hear around this is it wasn't really a solvency problem. It was a liquidity problem. If everybody had just sat tight for this entire time, then the deposits could have been paid back with the proceeds of the securities and the loans. So it was really just liquid. They just couldn't pay it back right away. Indeed, though, and what we're going to talk about in the next unit is that this concept of liquidity being the problem and not solvency, that's a false dichotomy. That we really don't see liquidity problems unless there are concerns about solvency. And it is this imperfect way of doing accounting that kind of gets us into trouble about confusing these as two different things. I've marked to market the securities, and I've marked to market the loans, and I've said, boy, if I do that, this is not a solvent institution. Okay, well, what's going on? Let's recall our picture of the yield curve from earlier. Lots of lines on this picture of the yield curve. This was showing us what was going on in 2019 and how it changed in 2020 and 2022. What I'm going to do now is take a lot of these lines off and add a couple more on. Now, what we're observing is everything has been removed here except the convenience yield. And this is now representing the convenience yield in 2022. What does that mean, convenience yield in 2022? The government yield curve shows that the government would have to pay about 4%, or north of 4%, pretty much all along their yield curve. How about this time Silicon Valley Bank? At this time, Silicon Valley Bank is paying significantly less than 4% on their deposits. It's moved up a little bit since 2019, but there's still a very big gap between what it is they are paying for deposits and what they could get if they just turned around and put that money in the shortest term US government securities that are out there. Okay, so easiest stuff to sell, no risk at all. They could just capture that difference. So how would that work? Well, here's where we're going to go back to this dotted line that we see here for the deposit rate. The circle, the yellow circle, is here telling us you can get your money out anytime you want. We see where that exists relative to the x-axis. This is a demand deposit. You can get it out tomorrow if you want it. But the dotted line is telling us something else. The dotted line is telling us we kind of hope you'll leave it here forever. And indeed, that is a big part of the business model of a bank. So one way to think about the deposits that exist at the bank and the convenience yield that exists at the bank is that just as we have to mark down the value of a bond on the asset side, the value of an asset, we have to mark that down when interest rates go up. Well, just imagine the other side of that curve. We owe people $170 billion, but we're paying a lot less on it than the market would want us to pay. We have to pay less on it. That's actually something that's helping us. Instead of we're earning less on it and it's marked down, we're paying less on it. Well, we should mark that down too. So effectively, that's what's happening in a pure market way of thinking about a bank balance sheet. Let's come back to December 2022. The red on the left is saying, hey, these securities that you have, they're paying a lower interest rate that's now out here. If I actually wanted to say what that would be worth if I went and sold it in the market, it would be less. Similarly, on the loan side, you're getting an interest rate based on loans you wrote a couple years ago. If I went out and tried to sell that to somebody, they would pay less for it. And indeed, when the FDIC sold that loan portfolio, they got less for it. Well, how about the deposits? Actually, we're saying it's $173 billion of deposits, but from the perspective of the bank, it's less than that. Because it's just like the same thing as the securities on the other side. It's something that's paying less, which we hope lasts a long time. But that only works if that dotted line stays a dotted line. The value to a bank of having a deposit franchise is essentially the value of, hey, I'm here, lend me money depositor lend me money at a very low rate and never take it out. And if people believe, and you have established the stability to get it, that will stay, then that's worth a lot to the bank. And it's worth a lot to their franchise value. So if we were to go back here, we would need to find a way to put that on the balance sheet. If we're going to move from an accounting balance sheet to a real mark-to-market balance sheet, we have to think about the equity value to a bank of having this wonderful business of people willing to give them money and let it sit there for a long time at a below even what the government has to pay interest rate. Where does that show up on this balance sheet? Nowhere. Okay? Essentially, we don't have a way to mark that to market. Okay? And we don't really have there's no way to put it on the balance sheet that is even a completely sensible thing. So what we've done is we started with a balance sheet that was all in orange. It was the accounting way of looking at what was going on, and it assumed we held everything forever. Then we started marking some parts of it to market and saying, ooh, well, if you had to sell everything today, you wouldn't be solvent. The bank and the investors in the bank would say, but I don't have to sell everything today. I have this very stable deposit franchise. Mathematically, what that means is I'd be adding a number to the equity piece to represent the value of that, to represent how much I was marking down, actually those deposits to be equivalent to the way I marked down the securities. If you do that, the overall market way of looking at the balance sheet would suggest solvency. But that solvency is completely predicated on the idea that the deposits won't leave. And the deposits get particularly twitchy to leave when they go and they look at your solvency without that value, and it makes them nervous. So in this way, the liquidity, the ability of the bank to hang on to its deposit base is just all tied up with the notion of how solvent it would be if that deposit base was not in fact stable. Okay, so we've covered what happened. And our second big question is, why did the government do things the way they did it? So what could the government have done differently here? Why did they take a series of steps? The first step is, why not just accept the securities, the $120 billion of securities and the $74 billion of loans? Why not just have the Federal Reserve accept those as collateral and loan the full face value on them and be done with it? They could give all the money, and if you actually give them all the orange that they need, they could pay all the orange on the asset side. They could pay back all the orange on the deposit side. And there are a few answers to this question. I think the simplest one, though, is to just note that from the perspective of an honest lender, whoever that lender is, that lender, the Federal Reserve in this particular case, lending to Silicon Valley Bank, really would have to recognize that what they were receiving in mark-to-market value was less than 120. So in a very real way, they're not fully collateralized, right? And the way we've set up our baseline emergency lending facilities in the United States is that the Fed needs to be fully collateralized. They're not supposed to just hand out more money to the banks than their things are worth. Now, you may have read that some changes were made in the midst of the crisis. That's so in the midst of these runs for some other programs. That's somewhat beyond the scope of what we're talking about here today. But the standing facilities that exist quite logically say, we're not going to just pretend that this stuff is in the market worth more than what that it's not worth more to us as collateral than it's worth in the market. And so the first position that the Federal Reserve is in, or any lender to Silicon Valley Bank, is that if we take seriously what these things would be actually worth as collateral, there's not enough. Okay? And the general rule to that, which is an important general rule in dealing with other types of bank runs, other types of crises that might happen outside of banks, is that you cannot lend your way out of what is ultimately a solvency problem. You will need to effectively be providing some sort of subsidy when you're doing it. So they could have said, oh, we'll lend you based on all of this, and we'll charge you a very low interest rate when we do it. That would be a subsidy. That would be legitimately, the word that we would use for that would be bailout. And that's not part of the standard operating procedures that they do. So that's why it wasn't easy to immediately lend. Now there's a bunch of technical issues that are, not surprisingly, when you have $120 billion floating around of things, it's hard to move that around real fast and lend on it. But even if you could solve those problems, you still have the fundamental issue, which is that if you had to liquidate the thing all of a sudden, it probably wasn't solvent. Okay, how about what the FDIC did? So we've talked a bit, and there's a lot of discussion by commentators about the deposits and about the fact that the vast majority of them, north of 90%, were not insured. Yet, over the weekend, following their announcement of the takeover on March 10th, the FDIC used the powers that they have to declare what's called a systemic risk exception, to say this is a systemically important resolution that we're about to do, which gives them the flexibility to do things like say, we will pay the uninsured depositors back. Now, this is thought of, I think, and it's certainly reasonable to think of this as a bailout of the uninsured depositors, where we think of bailout as we're giving them something they weren't promised. Ultimately, some combination of other players in the economy, and it's not a taxpayers, not the way they structured it. It's ultimately going to come from banks and their customers. But ultimately, some parties are being asked and forced to hand over money to the uninsured depositors of Silicon Valley Bank. They've been bailed out. Why do that? And I expect, although we're still in early days, that there will be a lot of discussion in time to come, in the weeks to follow, about who benefited from that and who were the uninsured depositors who ended up getting bailed out, and why are these people and companies, being many of them wealthy, benefiting. And I think that I haven't talked to the people who made this decision, but I know how I would have been thinking about it in their shoes, which is that it really didn't have anything to do with those depositors. What it had to do with is this picture. The difference between the dotted yellow line and the orange line. Okay? The difference between those two lines is this convenience yield, this franchise value for banks, for any bank, not just for Silicon Valley Bank. Where does it come from? It comes from the idea that that yellow circle actually is a dotted line, because it's not, even though people can take their money out today if they want to, they generally don't, because they generally feel safe. And they generally feel as though they're getting some convenience from what they're doing. And thus, the bank is capturing that difference. What happens if the FDIC says, well, bad luck, uninsured depositors, you're not going to get your money back? Essentially, at that moment, that's a pretty strong statement to everybody in the United States. Almost half of the deposits in the United States are uninsured. It's a pretty strong statement. You are very much on your own. Now, why didn't people think that already? They're uninsured. They didn't think that already because historically, sometimes they get bailed out. Sometimes they get helped. And the government has no real credible way of saying we're never going to do that again. So if you were an uninsured depositor at the end of 2022, you probably thought, I'm probably safe. If you were an uninsured depositor on March 12th, 2023, and the government said, absolutely not, we are not going to bail out the uninsured depositors of Silicon Valley Bank, whatever you thought your probability was of getting bailed out before, it has gone down. And if it has gone down, that dotted yellow line here, which means we think we're going to leave our money in here forever, suddenly is a little fuzzier. And the value that every bank in the United States gets from people being happy to leave their money with that bank at a low level, feeling that safety and willing to pay that convenience yield falls. So if you are, back to our balance sheet, thinking about solvency, and you know that a big piece of the ultimate solvency is tied up with liquidity and with the value of having a very, very sticky and calm deposit base, and you say these uninsured depositors who thought were probably covered, turns out they're not covered in this particular case, then all across the country, that piece, that value that every bank has, drops. And the concern that you would have if you are thinking about this problem from the country's perspective is, that's an actual real value thing. That's a thing that not only every bank in the country has as part of what makes them valuable, but enables them to do their job then of making loans. And if we pull that back, if we suddenly take away people's confidence in that, then we're going to see problems at more than just a couple of banks. And indeed, the runs that we have seen in history, which are very illustrative for thinking about the Silicon Valley Bank runs, help teach us that lesson. Because until the 1930s, we had no national deposit insurance in the United States. And we used to have runs a lot, right? And when those runs would happen, they would quickly get contagious. When people saw there was a problem at one bank, it immediately brought their attention to the question of what was going on at their bank. And once you look really carefully and start thinking about what it is that you're paying for, a lot of people start to move their deposits. You effectively take something that seems strangely ephemeral and make it ephemeral. So it used to be stable deposits, and it becomes unstable deposits with much less value, not just to one bank, but to the whole banking system. The third big question that we want to answer is, why do things this way? Seems kind of crazy, right? Why have a world where we're just running this risk that suddenly the deposit franchise of all the banks, people get nervous, maybe for legitimate reasons, and suddenly we need to come in and do something that certainly appears on some levels to be very bailout-y, giving money to some people who don't seem to deserve it. We'd like to avoid that. So let's go back to our balance sheet. And here's our balance sheet with just the orange on it. And let's imagine setting it up a different way. Okay, so if we recall, we have our deposits. The deposits are extremely short. And one of the dangers that we had is we had all this long-term stuff also on the balance sheet. And the long-term stuff, that can fall in value when interest rates go up and suddenly leave us with some solvency problems. It's one thing that can happen. So there's a set of proposals that have been circulating for really quite a long time in policy circles and among academics, which is just, why don't we make this a little more linked up? Why don't we just back things that are effectively like money, deposits, with other things that are short term? So instead of having the asset side of the balance sheet have on it all kinds of securities and all kinds of loans, let's just have short-term securities. Think government treasury bills that have a 30-day expiration. Have that be the only asset, and have the only liability, or the main liability, the same thing that we see here, which is just deposits. Okay? In that world, we're going back to this. Banks can still make money because they're going to pay the yellow dot, and then they're going to earn a return equal to the blue, very, very close to the yellow dot, all the way over, the shortest term blue. So banks will still make money. They'll still provide this service, which is turning government treasury bills, which are not a very useful thing to use to pay for your morning coffee, into something that you can use to make payroll and for your morning coffee. And that's known as narrow banking. You know that you've got a bank. The bank is going to be very focused on the creation of money through backing up deposits, and it's going to always back it up with the government with short-term government securities, where you don't have to worry about them falling in value. They don't move very much when interest rates change. All right, going back to our balance sheet now, you can see what that would look like. It's even simpler than the balance sheet that we originally started with. What would be the problem with this? What's gone from the balance sheet that we had before? Main thing that's gone, the most important thing that's gone, is loans, right? Who in this economy makes the loans? Who is it that is going to make sure that small business gets loans, that mortgages get paid? Now, you might say, well, gee, I thought there's a lot of non-banks that are involved in those things. There are, but very few of them are operating totally independent of the banking system. At the core of what's financing a lot of that is still deposits. To the extent that your economy needs to have loans that are long-term, and just frankly, most things that give us value take a while to come to fruition on one side of the balance sheet. And on the other side of the balance sheet, people needing to get their money quickly, so something that's very short-term like deposits. If your entire economy somehow needs to do it, making sure that the things that we call banks are not the place that it's happening doesn't mean that you eliminate the risk that your overall economy will crunch up when suddenly it's unable to pay for the long-term stuff with the short-term stuff. Indeed, one can think of the global financial crisis as essentially that happening. That in the global financial crisis, if you recall the names of that time, names like Lehman Brothers and Bear Stearns and AIG, the big failures and near failures were not banks. They were non-banks. They didn't actually have any deposits. Instead, they were involved in ways of doing the types of stuff that banks did, but without deposits. If you create a world where the banks are super safe, because they're not doing any of this turning stuff from long-term into short-term and back again, some other institution will do it. And we would be fooling ourselves if we think we had fixed the banking system or fixed the financial system by making sure that banks themselves, the things that we called in English banks, didn't have this problem. Because the problem would migrate. The ultimate cause of this is something that is fundamental to capitalism. And that is the things that give us value, either our educations or our house that we live in for a very long period of time, or the crops that we plant, or research and development for a new drug, take a long time. And many of them are uncertain. And what we need day to day is to be able to pay for our food. And so what the financial system effectively does is transform claims on all those long-run things in a very complex way so that we have something that's called money that we can use in the economy. Making sure that that doesn't happen in one very specific place or another specific place does not eliminate the need for it to happen somewhere in the financial system. Okay, so our fourth big question is, if we're going to have a system that looks like the one that we have now with something that looks like banks, what should we do to try to have this not happen anymore? And here the answer gets a bit more complicated. Since ultimately we're trying to do this alchemy of taking something that is long-term and enabling to have short-term deposits and claims on that long-term thing, if we're going to do that, we're ultimately always going to have some kind of risk in the system that maybe there's not enough to pay us back here. The typical way that this gets handled, and I think it's the right solution, it's just that we have to do the very best that we can to try to make it, to try to technically make it work as best as it can. The typical solution is back to the balance sheet. So we look here at the balance sheet and we look at where we were for Silicon Valley Bank in December 31st, 2022, where they had 15 billion of equity. And that 15 billion of equity was sitting below 212 billion of assets. So the first thing that we do is we say, I want to make sure that that's really 15. Or maybe I want it to be even more than 15. Okay, so that's called capital regulation. And you will hear a lot about this in the months to come. And if possibly you're watching this thing in the years to come, I'm sure people will still be talking about it, which is one way to make the banks safer, is to make sure that they have more equity relative to every unit of asset that they have. That would give you more of a cushion. If we think about why we had a problem here, the value of our assets fell, and it fell by enough to wipe out all the equity. So why not just have more of it? One complicated question that's out there is, why not have a lot more of it? So, gee, if 15 got wiped out, maybe we should go to 30. And by the way, maybe we should go to 100. What if half of this stuff was equity? That, unfortunately, is a question more complicated than I can answer in this 6-minute period. Suffice to say that the main problem, the main challenge of that is that if you tell a specific bank that they have to have a whole lot of equity, ultimately, where that comes out of is deposits. So if you look at this balance sheet here and you said you must have, to support this same amount of assets, half equity, well, that means there would be a lot less in the way of deposits. And remember, deposits are the way they make money, one of the main ways that they make money. So if you were to tell the bank, you can't do that anymore as much as you were doing it, it's a problem. And banks don't have a monopoly on doing it. Other types of financial institutions can do things that sort of look like it. And the banks end up sometimes being driven out of business. So that's the problem with making it go unbelievably high. But could it be higher? Could we be much more careful in how we calculate it? Could we be more on top of it? Sure, we absolutely can. The other thing that people pay attention to is how much, remember, the thing really keeping it solvent in a market sense is the value of that deposit franchise, right? The fact that people are willing to leave their deposits in there. So the other types of requirements that we try to get at are things that try to address how sticky those deposits are, just how valuable that franchise is, and how likely is it to disappear. And those are generally called liquidity requirements, and they're relatively new. We didn't have them in the same formal way that we have them today until after the global financial crisis. And so to some extent, they're still a work in progress. And they can be made better. And they probably can be made better in a way that they will work better with the capital requirements, which is the earlier thing that we discussed. I think, though, that it's really important to note that if we knew everything that we needed to know about how to make this system safe, it's probably still the case that we would occasionally get bank failures, and we would still occasionally get bank failures that turn contagious. Why is that? Ultimately, the financial system is a machine that's turning our short-term saving stuff into these long-term investments. And the machine itself is going to have in it just this inherent risk that there is no such thing as short-term stuff that you can demand tomorrow that just grows on trees. We have to manufacture it. And we can make that system very, very safe, but it will be at some cost to its ability to function. It's the same problem that we have with almost anything in our society where there's a trade-off between safety and efficiency. It's still the case in the city that I live, and perhaps where you are too, that we have far too many traffic fatalities and far too many people in cars and out of cars being harmed by cars. We could greatly reduce those by lowering all speed limits to 3 miles an hour and having unbelievably high penalties if you're caught speeding. That will greatly reduce all of the traffic fatalities we have with obvious costs to efficiency. In the banking system, it's harder to see those connections, but they're there. It is the case that when we decide to push really hard in one direction to make one piece of it more safe, two things happen. The activity itself that we've made safe on one road by changing the speed limit there moves to another road. If we can find all the roads that people run and change all those speed limits, now we're in a place where it's really hard to get anywhere. And that is an inextricable problem from having a financial system. So the second piece of what it is that we need to do is not only do we need to do the best we can to make sure that our financial roads are safe, but we also need to think really carefully about how we're going to deal with the system when it occasionally breaks down, knowing that that's something that is just part of the way the financial system is set up. In this module, we discussed the failure of Silicon Valley Bank, a very instructive case for understanding banking and bailouts. Nice and simple. If you want to go deeper and understand very complicated cases in banking and bailouts, I encourage you to study the global financial crisis of 2007 to 2009. Thank you.